Assalamualaikum. My name is Syed Jafar bin Abdul Rahman and my metric number 10DAT21F1059. I will present question 1. That is, describe 3 specific audit procedure that you will implement to respond to this risk effectively, and explain how each procedure addresses a different aspect of auditing equity and how it contributes to the overall audit quality. And the first one of audit procedure is review of equity transaction. Review of equity transaction that mean is examine equity transaction documentation, including board resolution, stock issuance, stock option grants, and any shareholder agreements. It is verified that these transactions are properly authorized, recorded, and disclosed in the financial statements and ensure compliance with legal and regulatory requirements. Next is procedure address about the review of equity transaction. This procedure guarantees that equity transactions are recorded and authorized correctly. It helps detect any unauthorized or unrecorded transaction that could lead to misstatements in the financial statements. It contributes to audit quality by verifying the accuracy and completeness of equity transaction record. Okay, the next one is contribution to audit quality about the review of equity transaction. This procedure improves the correctness and integrity of the equity accounts in the financial statement by scrutinizing equity transaction. It reduces the risk of material misstatements in this account, contributing to the overall audit quality by ensuring the financial statement reflect the true state of equity related the transaction. The second audit procedure is confirmation of equity balance. Confirmation of equity balance that means send confirmation to shareholders, particularly those with substantial holdings of common stock, preference share, or other equity instruments. Shareholders should be asked to confirm their ownership balance, dividends, and any relevant agreements or arrangements in the confirmation. The procedure address for confirmation of equity balance. Confirmation of equity balance directly deals with the existence and ownership of equity instruments. It verifies that the equity holders actually possess the share they are recorded as holding in the company's records. These procedures helps reduce the risk of error or fraud associated with equity ownership by independently confirming the information with external parties. And how about contribution to audit quality for confirmation of equity balance? Confirmations provide independent and external evidence of equity ownership, reducing the risk of misstatements related to existence and completeness of equity instruments. This procedure adds greatly to audit quality by strengthening the dependability of equity information in financial statements, ensuring that it appropriately represents the equity holder's position. And the last one, that is the third one for audit procedure, is testing of equity valuation and impairment. Testing of equity valuation and impairment is that means perform testing on the valuation of equity instruments, including a review of the company's procedures for figuring out the fair market value of common and preference stock. This could entail going over market data, financial models, and valuation related assumptions. And the next is procedure address about testing of equity valuation and impairment. Valuation of equity instruments can be significant risk, especially when companies use complex models to determine fair value. Auditor must confirm that the valuation is fair and consistent with applicable accounting rules. audited can uncover overstatements or understatements in equity values by thoroughly verifying the valuation methodologies and assumptions, which adds to overall audit quality by assuring the accuracy of the financial statement. Next is the contribution to audit quality for testing of equity valuation and impairment. By scrutinizing the fairness of equity valuation, this procedure reduces the risk of material misstatements related to overestimation or underestimation of equity values. It ensures that the financial statement fairly present the company's equity position. This improves overall audit quality by boosting financial statement correctness and reliability, and providing stakeholders trust in the reporter quality values. And that is for me. Thank you.
Assalamualaikum. My name is Amir Rafiq bin Amiruddin. Metric number 10D8021F1025 is going to present question 2. The first one is the various types of events that can occur after the statement of financial position balance sheet date. The first one is subsequent events. The first for subsequent events is recognized subsequent events. This occurrence should be included in the financial statements since they are representative of the circumstances that existed on the date of the balance sheet. For example, a customer's declared bankruptcy was not disclosed on the balance sheet date, even though it was anticipated at the time. This should be acknowledged as it may have an impact on the account's receivables collectability. Then, non-recognized subsequent events. These incidents serve as a sign of circumstances that did not appear in the financial statements and develop after the date of the balance sheet. They could nevertheless need to be disclosed in the footnotes. For example, although it is an unrecognized event, the appointment of a new CEO after the balance sheet date may be revealed in the notes since it sheds light on the direction that management will take going forward. Then, for non-subsequent events that have no bearing on circumstances on the date of the balance sheet and shouldn't be recorded in the financial statements are referred to as non-subsequent events. In order to maintain transparency and provide users of financial statements context, these occurrences might also need to be disclosed in the footnotes. For this example, the business operations of the company were impacted by a natural disaster that happened after the balance sheet date, such as flooding. Even if this is a noteworthy event, it shouldn't be acknowledged because it doesn't reflect the situation as of the balance sheet date. In addition, for material events and actions, these are acts or occurrences that the firm takes or that have an impact on the company. They may be of material importance and should be declared in the financial statements or notes, even though they are not specifically classified as subsequent or non-subsequent events. Examples: after the balance sheet date, the company made the decision to end a significant product line, which will have a significant effect on how it operates going forward. Next question: explain how these events should be treated in the financial reporting, considering the guidance provided by accounting standards and principles. The first one is recognition for recognized subsequent events. It has to be update the cash flow statement, income statement and balance sheet as needed to reflect the impact of the recognized subsequent event on the financial statements. Second one is disclosure for non-recognized subsequent events. Note that no changes have been made to the financial statements and provide an explanation of the event's nature and possible effects. The third one is recognition or disclosure for material events and actions. The event may be recorded in the financial statements if it is significant and representative of the situation or the date of the balance sheet. For the last question, types of post-balance sheet events. Recognize subsequent events, which these are occurrences that provide more details on the circumstances at the time of the balance statement. The financial statement should have included them. For example, a settlement amount should be recorded as a gain in the income statement and as a reduction in liabilities on the balance sheet if a firm had an ongoing lawsuit at the time of the balance sheet and the case was settled in the company's favor after the balance sheet date. Second, non-recognized subsequent events. These events point to conditions that develop after the date of the balance statement. They may necessitate disclosure in the footnotes but do not cause modifications to the financial statements. For example, a major contract that a company signs after the date of the balance sheet is not recorded in the financial records. However, in order to give financial statement consumers transparency, it should be disclosed in the footnotes. Third one, material events and actions. Even though they don't cleanly fit into the recognized or non-recognized categories, they are events or activities that financial statement users find to be extremely important. Example, a company's assets and liabilities may be severely impacted if it decided to terminate a significant product line after the balance sheet date, in which case the financial statements may reflect the change. If not, it needs to be revealed in the footnotes so that users are aware of any noteworthy modifications.
Assalamualaikum. My name is Muhammad Haris Ishran bin Muhammad Kazari. My number matrix 10DAT21F1006. I pick question number 3. But in question number 3, I already separate the question into 4 sections. And the first is, in a well-organized and comprehensive manner, elucidate the circumstance and factor that can lead to the issuance of a qualified audit report. A qualified audit report based on equity for preferred stock typically relates to specific issue or concern regarding the accounting treatment and presentation of preferred stock in a company financial statements. First is non-compliance with accounting standard. Among the scenarios that occur is that the company's financial statement do not comply with accounting standards such as Generally Accepted Accounting Principle (GAAP) or International Financial Reporting Standard (IFRS), and the situation that will occur if the company does not comply with accounting standard will cause inconsistency in reporting, making it challenging for stakeholders to assess the final health of an entity. And second is material misstatement. Among the scenarios that occur is the auditor discovers significant error or omission of items such as assets or liabilities that have a significant impact on the accuracy of the financial statement, and the situation that will occur if this material misstatement occur can distort the picture of the entity financial statement, potentially leading to incorrect evaluation by stakeholders. Number 3 is scope limitation. Among the scenarios that occur is the auditor is limited to do some of his work due to limitation imposed by the client, such as lack of access to the company system made on the company-owned security, incomplete documentation or legal constraints. And among the circumstances that occur is the auditor is prevented from getting a comprehensive view of the entity financial situation and raise doubt about the reliability of the financial statement.
Assalamualaikum warahmatullahi ta'ala wabarakatuh. My name is Muhammad Ikram bin Zazali. So today, what I want to tell you about, describe various 3 scenario and condition that may give rise to a qualified opinion by an auditor. The number 1 is not paying preferred stock dividend. The first scenario is the company is unable to make the preferred share dividend payment correctly according to the terms and conditions that have been promised and stipulated in the preferred share agreement that has been agreed upon by both parties. The significance is failure to meet full and prompt the payment of dividend may require the reclassification of the preferred stock as a liability instead of the equity, is disqualifying the auditor in performing his job to auditing. The second one is non-redemption of preferred stock. The second scenario is the company have the options to either redeem the preferred share but do not exercise these options, which is it leads to the potential for mandatory redemption. Number three is indicates disclosure of preferred stock terms. The last one and the third scenario that I want to tell you is the company is unable to meet the agreement and condition that have been agreed upon in the terms of providing a sufficient disclosure of the terms and conditions stated in the preferred share, including redemption provision or dividend preference. The last significance is this insufficient and incomplete disclosure allow this information related to the preferred share to hinder the understanding of each stakeholder about the rights and obligations in the preferred share. Potentially, it can leading to the disqualification of the auditor jobs.
So now I will answer the question about impact that will occur on the financial statement and audit process. Many of the impact that will occur on the financial statement and audit process involve the factor above. Firstly, non-compliance with accounting standard on financial statement may lead to material inaccuracies or error in financial statement that may confuse investors, creditors and other stakeholders. This can affect the decision-making of stakeholders in the process audit. There is an increase in audit risk. Auditor may need to implement extensive procedure to address compliance deficiencies that will result in audit time and cost. Secondly, the impact that will occur if there is an error to the auditor's financial statement is difficult to decide. Incorrect financial information due to material misstatement will lead to poor decision. Stakeholder, they will rely on financial statement to make investment decision. Loan, accurate data will lead to further financial loss. The impact involving process audit is an increase in inspection during the audit process. Auditor require assess and address significant manifest error and can increase audit costs and longer time because it requires a more extensive auditing process. Lastly, the impact that will occur if there is an error to the financial statement is the confidence of investors to invest in the affected company. The lack of clarity in the financial statement will give investors doubt about the financial health of the company and will affect their decision as investor. The impact involving process audit is an increase in risk. Scope limitation can increase the risk to the auditor due to limitation imposed by the company. Without complete information, auditors will not be able to issue their opinion, leading to potential risk in providing an accurate assessment of the financial statement.
Now I want to show you provide real-world example or hypothetically situation to illustrate your understanding of the complexities surrounding the issuance of a qualified report. So, this is the reports that sample report that I want to show you. So, I hope you understand what I am saying. That's all for me. Assalamualaikum and thank you for listening.